Somebody got excited. CUBA. Now, PEAD, right? Underreaction. Why is it happening? Because most of the time, the stock is in the dark. In the dark from the perspective of the traders, right? Doesn't come up to our mind too much. We don't pay attention too much, right? So underreaction seem to be going on. All right. Now, who found it? Bernard. Yes, 1992. Okay. Effect of inattention, right? Goes on like this. What do you see over here? The central part over here, horizontal line, the vertical line is the splitting part. Day 0, which is your earnings announcement date. Okay, earnings announcement date. And I told you before, forget about the price response. Forget about the price response on day 0 because it's going to be like all the way like from the 100% top or more, bottom like crazy, right? It could go anywhere. But what we are interested in is the cumulative abnormal return since plus 1 day. Plus 1 day all the way up to plus 60 trading days, right? Roughly 3 months. Roughly 3 months. It goes until the next earnings announcement. Well, why do we focus so much on earnings announcement? But what about other news, right? CEO fired or kind of ESG related news and all these kind of things. Well, you're right, but the most common most common type of news for corporations is quarterly earnings announcement or annual earnings announcement. And then they don't go through a lot of events like CEO firing or M&As or any things like that too much. Why? Those CEOs, right? Their average tenure is about 8 years in America. Not frequent. M&A, not that frequent for individual companies. So typically we study what we mean by news, right? Is earnings announcement like this. And then the rest of the period, we assume that there is no other important news events, right? Anyway, so that's earnings announcement. And then what we are interested in is the drift part like this, after the dates, right? What do we see over here? Well, the Bernard and the researchers, right? They classified, first of all, okay? Out of thousands of different companies in the US, they sorted by the degree of earnings surprise. I told you about our earnings surprise, EPS, right? Compared to the market consensus. There must be some companies who have a hugely positive earnings surprise and a hugely negative earnings surprise. So it's like 10% huge positive, 10%, 10%, 10%, all the way down to 10% worst earnings surprise like that. And then after the surprises, what's their cumulative abnormal return? Okay, that's what they graph over here. Okay, you see 10 different graphs. That's why 10 different portfolios, abnormal returns. What's the theoretical benchmark, EMH benchmark? Just like this guy, no surprise. Okay, and I say these guys are the usually no earnings surprise guys, but EMH benchmark is just like this as well. To the extent that the price or the investors responded immediately, just like semi-strong for market efficiency, then there should be no other price response during the period after the earnings announcement like this. So the graph should be flat like this, flat. But this one, you see it? It's not flat. Some of you may say, isn't it still flat compared to this, right? It's not this. Oh, come on. This is not. This is like what is it? Almost 3 to 4% return that you can get out of it. How about this one? Negative worst surprise. Well, about 3%. Okay, 3 to 4%. So what could you do out of it? Well, for this guy, positive earnings surprise groups, you know that there will be a positive drift like this. So what would you do? Take a long position, buy it. How about these guys? take a short position. Short, it's like a wait and then cover your short position over here. You can generate about 3 to 4% abnormal return over there. Over here, again, 3 to 4%, 2 to 3%. In total, if you take a long short position of this portfolio, and then you are going to get like a 6% abnormal return, 5 to 6% abnormal return over 3-month horizon. So that's what the PEAD is about. And then some of you may wonder, oh my goodness, what's happening over here before the earnings announcement? There seem to be some of the drift or pre-announcement drift happening. Yeah, you're right in some sense, because analysts in the market closely watch these companies before the actual earnings announcement. So for the companies that it's going to have negative earnings surprise, we already know to a certain degree these guys will be, disappointing. So the price move downward even before the announcement. Okay, there's a pre-announcement drift like this. Information leakage and then market expectation, okay, part. It's not that important for your study right now. But what is more important is this one, okay? Post earnings announcement drift is there, okay? And then it's a clear underreaction part, not overreaction, okay? And then why is this happening is our interest. There has been interesting questions to the researchers in financial economics and behavioral finance especially. And this kind of things, right? It was in 2009, Hirschleifer, Lim, and Teo's paper. They found some result that's saying a lot of the drift, right? A lot of the underreaction seem to be driven by distraction. I told you, these are the stocks in the dark. If you get distracted, right? As an investor, if you get distracted, all the stocks in your portfolio are just like in the dark. You don't pay too much attention to all different stocks. Even more so when you're distracted a lot. Okay? When do you get distracted? Well, earnings announcement clusters on one day, or there's earnings season, we say it, one whole week, right? All those companies announce their quarterly performance simultaneously. So for example, in one day, 500 companies announce their quarterly performance simultaneously. Would you pay equal attention to every different stocks and then respond quickly and enough, right? No way. Okay? You have limited attention, okay? And then the weekdays also matters over there. So Hirschleifer, Lim, and Teo. Lim is a professor, a Korean professor working in Seton Hall University, and then David Hirschleifer is president of American Finance Association, right? And his wife, Professor Teo, in accounting department. They are big shot guys, right? Big shots. A big star in behavioral finance anyway. So what they find is like this. In the horizontal axis over here, what you see, that's earnings surprise deciles. I told you before, you classify those stocks from the highest surprise to the negative, most positive surprise to most negative surprise, right? 10 deciles like this. 10%, 10%, 10% like this, right? This guy on the top should be on the most right-hand side over here, 10th. These guys are the most disappointing guys, okay? Disappointing surprise. These guys are roughly in the consensus range. Analyst has been expected that. This one is CAR01. That's on the day of the earnings announcement. Day zero return, day zero. I told you over here that we don't pay attention to day zero return. What we care about is this part, but Hirschleifer and Lim and Teo, they paid attention to the day zero return just to see how much of an underreaction versus overreaction is going on. And then what they classify with two different graphs is like low news days versus high news days. Low news days is the companies when they announce their quarterly performance, right, annual performance or quarterly performance, that are not contaminated by other companies' news, right? Not distracted earnings announcement. And the gray line over here are the group of companies that are announcing their performance simultaneously with so many other companies, right? So highly distracted announcement versus not distracted announcement. On the day of the announcement, the magnitude is much bigger, okay? For non-contaminated, pure or non-contaminated, non-distracted announcements like this, right? For highly distracted news, less of a degree of response, you see it, right? So underreaction on the day of the announcement is documented like this: underreaction instead of correct reaction, correct reaction benchmark like this. And then this is just day 0 to day 1 return, right? How about the drift from day 2 to day 61 like this for the same quintiles or deciles of positive to negative earning surprise. The most positive earning surprise, and then the cumulative abnormal return is very, very big, right? And then most negative earning surprise, the drift is most negative like this, the gray lines over here, okay? So you see a huge amount of drift like this if it is highly distracted earnings announcement, okay? Highly distracted. Remember highly distracted earnings announcement? Well, on the day of the announcement, there was a underreaction like this, but the drift is bigger. You see the contrast? And then pure earnings announcement, non-distracted earnings announcement, well, the immediate response is big enough. And then the drift is very, very small like this, okay? So it's coherent with the story that, the simultaneous earnings announcement by so many different companies distracts those investors so that it causes some PEAD, post earnings announcement drift. Okay. Again, limited attention, right? Bounded rationality is an important factor. EMH, good luck. And then another piece of evidence about this distraction was recently found by Professor Daniel Schmidt of HEC Français. He worked with big data about institutional investors trading, buying and sell order, right? And then he went through all this kind of earnings announcement date and minute by minute, second by second trading. And he found out that if it is, right, if the earnings announcement is confounded by so many other earnings announcement, then even the portfolio managers, like the hedge fund managers or mutual fund managers, usually mutual fund managers in this data, they get distracted and then they click this buy and sell belatedly. Okay, belatedly. Previously over here, right? The behavioral finance guy were not challenging to Eugene Fama too much, and saying that, oh yeah, we get distracted. And then it is usually the individual investors that are distracted more. But institutional investors, they are smart money. They will be different, and then they will be more like what the traditional economists predict, right? But this one is challenging more seriously to the existing economists, right? Even the institutional investors get distracted like crazy. And then what he finds is that those institutional investors make systematic mistake because of this distraction. Simultaneous earnings announcement. Let's say you are Samsung Life Insurance asset manager, right? Asset manager, and then you hold, essentially thousands of stocks in Korean market, and those guys are doing the earnings announcement on the same day, and there is all different degrees of earnings surprise, and you have to respond quickly. Would you be able to respond quickly enough? The answer is no, no way. Okay. Even the institutional investors make such mistakes, and then those guys, distracted managers, trade less profitably, and then incur significantly higher transaction costs and display stronger disposition effect. He has the data of these kind of institutional investors, trader by trader trading data, so that he can trace back to how, when they sold and when they bought. And then disposition effect, what the heck is that? You may wonder. We're going to learn about this concept in the next few weeks. But this is one of the two biggest enemies in your trading, in stock investment. The biggest enemy in your stock investment is disposition effect. The second biggest one is overconfidence, by the way, as a preview. Okay. And so, having said something about disposition effect, what is that? Just quickly, just the overview is like this. One of the, disposition effect, it has two different states. Once you purchase, let's say you purchase cacao in the beginning of this year, and you know what happened over the last 10 days, right? The price plunged by about 23 or 25%. Okay? And let's say your investment rule is that you have to cut loss at negative 20%. Okay? Now I said the cacao stock plunged by 25%. Would you really sell off your cacao stock following your investment rule, loss cut rule, 20%? Would you be able to sell them quite easily? And the answer is no. 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 Why no? You're going to learn about this. Why is this difficult to sell, right? Psychologically, you will not be able to sell it quite easily. You don't want to accept your mistake. Why did I invest in cacao? I'm so stupid to do that. Not foreseeing what's coming up. It's so painful to realize the loss. We call it loss aversion. Okay? So painful. So what you do, chombo in Korean terminology, is just hold on to this money-losing stock, believing that, it's not still, I did not realize this loss. This is just a paper loss. Okay? I'm going to just keep it to the end. And then by the time I die, I will just give it to my son and daughter and say, like, you sell it later on, but not in my own eyes, in my living eyes, right? That's loss aversion, one face of disposition effect. The other face of disposition effect is like, let's say this cacao, okay, money lost, but you chonbo, right? You just held on to this stock, and then luckily, the stock started to jump up, and then recovered their original purchase price. Wow, and then started to make money, like 1% or 2%. What do? 1% up, 2% up compared to your investment. Chances are you will sell off and realize the gain instead of holding on and wait for more gains. If you learned about momentum, right? This is the moment when this is the moment when this actual momentum is taking place, so that you have to be able to wait and realize more gain. But kind of a bird in a hand kind of concept. You abruptly become more risk averse, and then I'll be happy to gain just 1% return, okay, and then exercise or just sell it off, okay, and then stay happy with the small amount of gain. That's the other face of this disposition effect. both of them never good for your investment life, right? So that's why some of the YouTube stars like Kang Hang-guk, right, say disposition effect is like a Stalin of your investment life, worst enemy. Okay, watch out. Yeah, and then this graph is a supporting evidence about this distraction effect of the fund managers, the institutional investors. Okay, by Daniel Schmidt's paper. Okay, over here. Anyway, so evidence against market efficiency, we have studied it until now. So efficient market hypothesis says that you cannot predict the price movement because it's a martingale. All the information is already reflected in the price. Whatever trading strategy you can dream about based on those information is already priced. So trading strategy, good luck. It's not going to work. Price, is it predictable? No way, right? Predictability means like the information is not reflected yet. Okay, but the evidence that we found so far is that it is predictable, which means defies the notion of efficient market hypothesis, right? Predictability, you found it. Okay, so what? Now behavioral finance guys would say this is anomaly, and then this is behavioral finance guys would say this is mispricing. Okay, you can never have a perfect, the psychology will drive this kind of anomalies, and then it's not, we cannot fully incorporate everything into the expected return model, risk return model. Good luck with that, right? Just recognize this is mispricing, and then we can make money. Okay, some smart monies, and then the smart investors can systematically make money out of it. All right. But the rational or the Chicago, Minnesota, Carnegie Mellon style economists, they say they don't agree. Okay, it's not a mispricing. It's not a mispricing. There is a concern. There are some concerns. Number one, there could have been some wrong controls for risk, expected return model being wrong. Okay? What do you mean by that? Well, I told you over there, right? Expected return model, right? Maybe we were using CAPM, but is there a guarantee that the CAPM is correct? Absolutely correct one. And the answer is no, it's just our grandpa model of imperfect risk return model. It's a holy grail that we will not be able to, fully grasp the perfect risk return model. But we are in a constant search of it. Okay, the risk factors. CAPM, that guy is just one factor model, but by and by we incorporate other risk factors like value factors or size factors and then things like that. And then hopefully we will be able to reach the ideal stage of perfect risk return model someday. Good luck. And then number two, they would say statistically, is it significant? You found out some abnormal return like that, right? 2% or 3%. And then statistically, let's test whether that return, abnormal return, is significantly different from zero on average, right? So to econometrically test statistical significance. Is it robust? Okay, different time period and a different market. Do we see that? And economically, is that significant enough? Or can you make enough money out of it? Thinking about those transaction costs, right? If the transaction cost is too huge, let's not bother it, right? Within the range of transaction costs, there could be some anomalies. No surprise, okay? That's economist argument. And then wrong control for risk. Well, predictability of abnormal returns sometimes sensitive to benchmark model like CAPM, or whether you use 3-factor models, 4-factor models, things like that. So what can be done? Try many risk models, right? Like CAPM or 3-factor, 4-factor, or N-factor models. You try it, and then if you keep on finding, you still find some significant anomalies, then you have a goal. In some cases, risk is just implausible, they say. And then, for example, January effect or Jung Junhyuk, one of you guys, right, graciously reported that the Morgan Stanley was finding some April effect days instead of January effect. Somehow, the January effect is depleted by so many investors are now aware of it, but somehow April is a new thing coming up. But this calendar effect, right? Whether you call it January or April effect, this kind of things is not fully explained by risk model. Okay, why should there be some high risk for certain month versus not? Understandable. Mispricing makes more sense in that case. Circumstantial evidence that some predictability reflects mispricing. See more predictability where arbitrage is more limited. Well, what do you mean by this? There are some stocks that in which those arbitrageurs or short sellers cannot work efficiently. They cannot short sell easily. Okay, small stocks, right? Illiquid stocks, dangerous to short sell. GameStop kind of things. We saw that sometimes the short sellers can be squeezed to death like that. So arbitrageurs cannot work nicely over there. Naturally, the price of such stocks will be away from efficiency level. Okay, that's the point over there. Statistically significance, right? Standard errors too small. They don't reflect the data mining. Is that being too large? What can be done? Look at the new data. Okay. See whether results hold for different time periods. Let's just like Junhyuk found, right, in the Morgan Stanley argument, right? Maybe in the new era, right, more recently, January effects seem to have been weakened or somehow. Maybe we should test it, right, or over different time periods. And then some of the media-driven effects, CEO interviews on CNBC, kind of, right? One of the things that I had to do was to test whether the CNBC interview price response is different for different time period, like initial 1990s period versus 2000s period, right? And I found that the response is persistent. It just does not go away. Okay, if you have this kind of pricing pattern, then you have significant findings. Otherwise, usually what will happen is like those strange pricing patterns, anomalies, are more prevalent in longer history, previous history, but most of the anomalies are gone these days. Most of the anomalies are disappearing. Why is that the case? Because of the publication. Those hedge funds pay attention to academic publication about these anomalies, money-making chances, so that they start to trade on these papers. So those anomalies gets disappeared, smaller. And the new anomalies pop up, okay? And then, so those things you should pay attention, and then check whether novel predictions of an economic theory are borne out. January effect stronger for prior year losers and consistent with the novel prediction of a tax loss selling. Simultaneously, it gives confidence that January effect is real. Anyway, economic significance, yeah, cost-wise, right? Trading cost. That's that. So I hope you enjoyed this lecture. And then after this week, we're going to go through some of the important psychological biases of the investors. But before that, we're going to touch on the something called the benchmark model, called the expected utility theory by rational economists. So wait for that, and then I see you later. Bye-bye.